Good day, everyone. So, we are going to discuss dividend policy and the subject financial markets. Before we proceed to the lesson, let me introduce to you the members of the Group 8. The member 1 is me, Katherine Aplacador, Lezrae Ilumba, Ziviera Sanchez, and Jeann Tayabas. In every lesson, of course, there is a lesson objectives. So, at the end of this topic, you will know how to describe the dividend policy, explain the dividend theories, solve problems using a residual dividend model, and apply the effects of stock dividends, stock splits, and stock repurchases. So, what is dividend policy? It is the decision to pay out earnings versus retaining and reinvesting them. A dividend policy is the policy a company uses to structure its dividend payout to shareholders. Some researchers suggest the dividend policy is irrelevant in theory because investors can sell a portion of their shares or portfolio if they need funds. Next is dividend irrelevance theory. So investors are indifferent between dividends and retention generated capital gains. Investors can create their own dividend policy. It is proposed by Modigliani and Miller and based on unrealistic assumptions, hence may not be true and need an empirical test. So why investors might prefer dividends? So we may think dividends are less risky than potential future capital gains. And if so, investors would value high payout firms more highly. For example, a high payout would result in a high P. Why investors might prefer capital gains? May want to avoid transaction costs. Maximum tax rate is the same as on dividends, but taxes on dividends are due in the year they are received, while taxes on capital gains are due whenever the stock is sold. If an investor holds a stock until his or her death, beneficiaries can use the date of the death as the cost basis and skip all previously accrued capital gains. Next is what's the information, content, or signaling hypothesis? So investors view dividend increases as signals of management's view of the future. Since managers hate to cut dividends, they won't raise dividends unless they think the increase is sustainable. However, a stock price increase at the time of a dividend increase could reflect higher expectations for future EPS, not a desire for dividends. So, what's the clientele effect? So, different groups of investors or clienteles prefer different dividend policies. Firms' past dividend policy determines its current clientele of investors. Clientele effects impede changing dividend policy. Taxes and brokerage costs hurt investors who have to switch companies. What's catering theory? It is a theory that suggests that investors' preference for dividends varies over time and that corporations adapt their dividend policy to cater to the current desires of investors. So, corporate managers are more likely to initiate dividends when dividend paying stocks are in favor. Corporate managers are more likely to omit dividends when capital gains are preferred. So, let's proceed to the residual dividend model. So find the retained earnings needed for the capital budget. Pay out any leftover earnings, including the residual, as dividends. This policy minimizes flotation and equity signaling costs, hence minimize the WACC. As we can see, we have here the residual dividend model. So dividends is equal to net income minus the target equity ratio times total capital budget, close and open parentheses. So we have here some example is capital budget is 800,000 and the target capital structure is 40% debt and 60% equity. So forecasted net income is 600,000. How much of the forecasted net income should be paid out as dividends? So next is, so let's try calculating dividends paid. So calculate portion of capital budget to be funded by equity. Of the 800,000 capital budget, zero point 0.6 of 800,000 is equivalent to 480,000 will be funded with equity. So next is calculate excess or need for equity capital. With net income of 600,000, there is more than enough equity to fund the capital budget. There will be 600,000 minus 480,000 and the result would be 120,000 left over to pay as dividends. And next is calculate dividend payout ratio. So 120,000 divided by 600,000 is equivalent to 0.20 or equal to 20%. And now let's put in a situation that what if net income drops to 400,000 and rises to 800,000. So first, if net income is equivalent to 400,000, well, the dividends is equivalent to 400,000 minus 0.6 um, times 800,000 is equivalent to negative 80,000. Since the dividend results in a negative number, the firm must use all of its net income to fund its budget and probably should issue equity to maintain its target capital structure. Though the payout is equivalent to 0 divided by 400%, of course equivalent to 0%. And if net income naman is 800,000, dividends is equivalent to 800,000 minus 0.6 times 800,000 is equivalent to 320,000. So the payout would be 320,000 divided by 800,000 is equivalent to 40%. So how would a change in investment opportunities affect dividends under the residual policy? So fewer good investments would lead to smaller capital budget, hence to a higher dividend payout. More good investments would lead to a lower dividend payout. So for the final slide, we have the comments on residual dividend policy. Let's start on the advantage. It minimizes new stock issues and rotation costs, while in disadvantages, results in variable dividends, sends conflicting signals, increased risk, doesn't appeal to any specific clientele, and for the conclusion, consider residual policy when setting long-term payout, but don't follow it rigidly from year to year. So that would be all. To continue my topic, which is setting dividend policy, Let's have Lezrae Cheska Ilumba.
To continue about dividend policy, there are steps in setting dividend policy. Number 1 is forecast capital needs over a planning horizon over 5 years, set a target capital structure, estimate annual equity needs, set target payout based on the residual model. Generally, some dividend growth rate emerge. Maintain target growth rate if possible, varying capital structure somewhat if necessary. What is Dividend Reinvestment Plan or DRIP or DRIP? Under DRIP, shareholders can automatically reinvest their dividends in shares of the company's common stock. DRIP are plans that enable stockholders to automatically reinvest dividends received back into the stock of the paying firms. Under this plan, stockholders choose between continuing to receive dividend checks versus having the company use the dividends to buy more stock in the corporation for the investors. In other words, the firm gets more stock than cash. There are two plans under the Dividend Reinvestment Plan. The first one is the Open Market Plan and the New Stock. Under the Open Market Purchase Plan, pesos to be reinvested are turned over to trustee who buys shares on the open market. Brokerage costs are reduced by volume purchases. Convenient, easy way to invest, thus useful for investors. Open market purchase plan involves only old, already outstanding stock, and the company gives the money that stockholders who elect to use the DRIP would have received the bank, which acts as trustees. The bank then uses the money to purchase the corporation stock on the open market and allocates the share purchase to the participating stockholders' account on a pro rata basis. The transaction costs of buying shares are low because of the volume of purchases, so these plans benefit small stockholders who do not need current cash dividend. The next plan is the New Stock Plan. Under the New Stock Plan, firm issues new stock to DRIP enrollees, keeps money and uses it to buy assets. Firms that need new equity capital use New Stock Plan. Firm with no need new equity capital use Open Market Purchase Plan. And most NSYE listed company have a DRIP, and these are useful for investors. In the New Stock Plan, this involves newly issued stock. These plans raise new capital for the firm. In either case, the stockholder must pay taxes on the amount of the dividends, even though stock rather than cash is received. Stock dividends versus stock splits. Stock dividends. Stock dividends are dividends paid in the form of additional shares of stock rather than in cash. In stock dividends, firm issues new shares in lieu of paying cash dividend. If 10%, you get 10 shares of each 100 shares owned. Stock splits. Stock split is an action taken by a firm to increase the number of shares outstanding, such as doubling the number of shares outstanding by giving each stockholder 2 new shares for each one formerly held. Under stock splits, a firm increases the number of shares outstanding. Let's say it's 2:1, then sends shareholders more shares. Both stock dividends and stock splits increase the number of shares outstanding, so the pie is divided into smaller pieces. Unless the stock dividend or split convey information or is accompanied by another event like higher dividends, the stock price falls so as to keep each investor's wealth unchanged. But splits or stock dividends may get us to an optimal price range. So when and why should a company consider splitting its stocks? Number 1, because there is a widespread belief that the optimal price for stock is 20 pesos to 80 pesos. Stock split can be used to keep the price in this optimal range. Stock splits generally occur when management is confident, so are interpreted as positivity signals. On the average, stocks tend to outperform the market in the year following a split. And if a company splits its stock or declares a stock dividend, will this increase the market value of its stock? From a pure economic standpoint, stock dividends and stock splits are just additional pieces of paper, but they provide management with a relatively low-cost way of signaling that the firm's prospects look good.